Guys, welcome to another week of UK property market update. And all my house price predictions, my recession. We're gonna go through a whole range of stuff today, actually. And what I'm really trying to build is a real theme on these sort of things. And I think that the key here is, for me, it's not about up, down, staying where it is. It's about how can you as a property investor actually see yourself through this period, and whether it be a down or an up, in prices, whether it be a horrible recession, a long recession, a short recession, it doesn't much matter, because if your portfolio is structured right, and if you understand the strategy and how to make the strategy meet the market, and you've got good advice, and in the absence of good advice, okay, because let's face it, it's hard to know who to believe these days, okay, in the absence of good advice, that you have a property that's bought with great fundamentals. Okay, and because that's likely to be the area that bounces back the quickest, that is able to sell the easiest, and all these sort of things. And I think that's really important, that you need to get these fundamentals up front and worked out. And I think that's what a lot of I want to achieve here today, as well as the news and update you and things like that. But I think if you can get some certainty, and I think that really is the key for all this. Yeah, and that's why every week I'm coming to you and and recording this and doing all the research, just to give you a property investor's opinion. So what are we covering today? Okay, so what we've got is are house prices defying gravity? CBRE, sorry, not CBRE, CEBR predicts 13.8% drop, okay? Are buy-to-letters fleeing the market? Construction's up, is that good or bad? Boris is 95% loan to value, is that good? Or is it a disaster waiting to happen? London buyers, where are they? Yeah, overseas investors window, opportunity window, I mean by that. And my rant, why London is still a safe bet, and not only that, but what that means for places like Birmingham and Manchester and Liverpool and all the major cities. Okay, and really, as I've mentioned, it comes down to fundamentals, but we'll talk a bit about that real soon. So look, recession watch. I mean, there's so much stuff happening now, but it's amazing because all the talk for the last 3 months has been all positive and bang gangbusters and how wonderful it is. Now it's all about, but the winter's coming, and things are going to drop, and 2021 is looking bad, and and all this sort of stuff. Mind you, it's nowhere near as bad as a lot of people may have predicted, and we could have ended up. So I think one of the keys here is to really keep your wits about you. And I mentioned before, in the absence of knowing where the hell to turn or who to listen to, let's get property has really good fundamentals. Or if you can't, let's put as much fundamentals in place as you can, whether it be good tenants, whether it be good property management, or whatever it is, and get that up running now before whatever happens may happen, whether it be up, down, left or right, or any market like that. Okay, so let's get into it. So basically, look, UK house prices see biggest jump since 2016 to hit fresh high. Wow, that's amazing news. But it won't last long, says property experts. And there are a few experts who are saying this, and that's fair enough. And I love this, defying economic reality. I think that's a headline grabber. But, I'm always talking about headlines and that sort of stuff. But the interesting thing is, the guy that said that, actually, I agree with what he's saying. It's been great, but it's not going to continue. And I think things are bound to slow down. That's just what's going to happen. So, don't rely on this to continue through the winter. It never does. Things slow down now. You expect that. We've already seen Rightmove, their inquiries starting to drop down. I think it's down 7%. So that will continue. Yeah, that will continue all through the winter, especially now that we've got, harder lockdown. Well, not lockdown, sorry. We shouldn't call it lockdown, should we? It's certainly not as bad as it was, and I doubt they're going to go into another lockdown. I think economically that might create problems for them. So yeah. So let's have a look at CEBR, the Centre for Economics and Business Research. Now look, prices expected to tumble in the coming months. Now you might say, Brett, why are you showing me this? You're supposed to be a property guy, and you're supposed to be upbeat about everything. Well, the reality is this possibly could happen. But the interesting thing I found with these, and forget what they say, look, the tumble, blah, 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 13.8% lower in things. So that's their prediction. If you remember, my prediction was -3% last week. Now, interesting, if you look at who CEBR is, it's a rare thing in economics, a consultancy with a tendency to get things right. Well, these guys, I've been tracking them for ages, and in actual fact, I find that they're wrong more than they're right. As I say, most experts are wrong most of the time, but they continuously get column inches. And interestingly, if we go back to that slide, regular reports, attention-grabbing, original, newsworthy, regular reports. Now, for me, that's not a good thing if I'm an investor trying to listen to that. Attention-grabbing reports, newsworthy, that sounds more like they're trying to get column inches than they are trying to give you really good advice. You know, UK housing bubble set to burst. Now, the interesting thing with 14% hit in house prices, interestingly, if you look at most of the news, and most of you guys already know this if you've been watching me, most of the news is just rehashed stuff. So somebody produces a report and then everyone else rehashes it. That headline is literally based on CEBR's report that says that. So it's interesting with this whole thing. Are we to believe that? Look, when you go in on their website and read the report, there's perfectly valid reasons why this should happen. But I think actually when we talk about death-defying, defying gravity and things like that, and 14-point this drop and all this sort of stuff, my challenge with this is the one big thing that we haven't accounted for and a lot of people aren't talking about is how much liquidity there has been pumped into the market. And we're talking about around about 30%. So if you look at the entire cash, and let's call it cash, it's not technically cash, but money supply, okay, that was in there, it's increased about 30% in 2020, yeah? Now that's incredible, that's unprecedented. So most people would say that's gonna cause massive inflation, yeah? But it's only gonna cause massive inflation if it's, they put too much in. If that's what the economy needs to stay where it is, then that's what it needs. Now, the trick is how do you come out the other end and grow? And that, I think, is having one of the challenges that we'll talk about. But anyway, so I thought I'd add another segment, which is adding in a little outside broadcast that I went out and did today. So yeah, here we go. So whether buy-to-let investors actually are going to flee in droves, I'm not so convinced. In my experience, 25 years, I've seen lots and lots of changes over that period. More compliance, more regulation, more costs being layered on layer. But actually, what happens when the dust settles, you find a way to make the investment work. And invariably, you make money. Now, there's the people that jump out that are still looking at and wondering what the hell to do. So I think the key here is to work out your own portfolio, where it sits. If you need to offload a couple of properties, that's fine. Stay focused, get your strategy, make sure that strategy meets the market. And I think you can see your way through this. And actually, there's not too many other things that can go. Yeah, they can add all sorts of things, but the market adjusts. And when the market adjusts, then it gets back to making money. Make no mistake, the market knows how to make money. But if you're not involved in it, if you jumped out of it, the likelihood is you're going to miss out on that opportunity for revenue. And let's face it, where else are you going to go? I think that's one of the key distinctions here is where are you going to put your money? What are you going to put your money into if not property? Yeah, shares, build to rent, pensions, all these sort of things are really, they're off market to you as an investor. What you have to do is give your money to another fund who's then going to control it all. And really, I believe that's where the government and that's where a lot of big corporation and pension funds are pushing. They want to control these assets, okay? So don't let them. Don't jump out of the market just because of this. And I think I just want to pick up on that one point because I think this is this is for me the key point here. If you jump out of buy-to-let, what else have you got? Because pension funds, their returns are dropping. They're not getting anywhere near the returns they were or near the returns that you can get out of buy-to-let still. If you look at things like, going and doing development and the risks associated with that, if you look at the things of like investing in shares and the risks attached with that and the time you need to put in, when you factor in all these sort of things, you've got to sit there and look at the time cost as well as the risk, as well as the potential upside of return. And I think when you start looking at that, and you've got here property funds, holding 12 billion face reopening dilemma, you've got here, like things like pension funds, which are out there and they're trying to find these big, massive developments because they're getting all this pension money, which governments are driving people into pensions and pensions are looking for assets to invest in. And the problem is with so much liquidity, guess what? The results are likely to go down and down. So where are you going to put your money? And this is the problem. You can say, well, I'm jumping out of buy-to-let because buy-to-let's no longer what it was. No, but neither is pension, neither are shares, neither are that. Now, you might say, but hold on, shares went up this much and that sort of stuff. And absolutely, if you can read the market and you're that good, fine, But for the most people, they don't have the ability. They're not trained in that. They don't experience in that. They're not that risk, they're not that risk profile. And when you factor those in, that's something to consider, okay? Look, one of the big things and one of the big moves is the, UK build to rent, seeing record levels of investment. Now let's talk about build to rent. So what build to rent is simply this, and this is where I think what's happening is these pension funds, these big companies that have billions and billions of dollars getting pumped into them, they need somewhere to invest their money. And so where are they putting it? They're putting it into housing, okay? And this build to rent thing has been born, which is basically we build it and we rent it out. Yeah, so they own it and they earn a return off it. Now, interestingly, they're putting billions in to buy to let. It's buy to let. There's no two ways about it. They're not getting more than the market rent. They're not getting, they're subject to the same things that we are as landlords. But the reality is they have a big coffers to be able to pay for these things and have hire staff and to do all this sort of stuff. But build to rent is a massive, massive growth area. Yeah. Now the question is, do you jump out and go somewhere else? Where do you go? Or do you ride on the coattails of these giants? And for me, that's what you need to be doing, is you need to be sitting there going, you know what, I'll take the hits because I know at the other end, there's profit there, because these massive, massive companies are dumping billions into build to rent to build these big developments, yeah? And actually, you're going to supply a market that they're not supplying. They're doing flats mainly. They may be doing a few houses and that sort of stuff, but for the most part, the stuff that you and I will be investing in is not necessarily the stuff that will compete with the stuff that they're doing. So, heaps of opportunities. Now, in terms of coming back to house prices and actually looking at what's happening there and the future, and I'm not talking about today, I'm talking about in 2 years, 3 years, and where the market's likely to be. Strong housing market fuels UK construction industry rebound. I'm not sure that's correct, okay? Because you don't go out and build because there's a temporary stamp duty thing. You don't go out and build just because, things are good now. You need them good in about 3 months' time. You'll see the rebound. Now, interesting, that 50 there, okay, on that map, that is neither growing nor shrinking. So anything below that means it's shrinking. Anything above 50 means it's growing. So as you can see, it's growing again for the first time really since Brexit, okay? So, that's quite good news for us, yeah? Because what that does is that supplies property in the next 2, 3, possibly not 4 years, probably the next 2 or 3 years, maybe some 12 months in the smaller stuff, okay? So that's good news, because if people, number one, if funders are willing to give the money and developers are willing to invest, that is good for the market, because those guys are pretty astute. They do a lot of research. I know, because I hang around a lot of these guys. I speak to them. I'm constantly questioning them about the market and that sort of thing. So I generally feed off them, and a lot of the stuff that you hear is conversations that I've had with them. Really getting into the nitty-gritty with them. Okay. All right, let's change it up. Boris strikes again, hey? So lenders left wondering how PM's homeowner pledge will be achieved. So basically what he's saying is 95% mortgage for first-time buyers. I love this, okay? And I love it. I think it's an essential part of the market. And in actual fact, for me, I don't think the guy right now, can step wrong in the things that he's doing when he's incentivizing the market. Now, yes, the lenders are being arrogant twats, to be fair, because what they're saying is, oh, how are we going to do this? We're not prepared to take the risk. You know what? The government should just go, you know what? We'll manage it. You'll lose all the money, and watch how quickly they come running. The fact is, 95% mortgages, the reason they don't want to give 95% mortgages, there's a risk of the downside. So if there's only 5% equity there and prices drop, that means they're in negative equity. That can cause problems for the banks. So I get that, yeah? So they're not total twats, but they are kinda, because the problem is they want to help you at the best of times and then they stooge you at the worst of times. When really, that's when, to be fair, that's when the government should be jumping in and doing things like 95% mortgages. I love this concept. If we want home ownership to be a cornerstone, an Englishman's home is his castle, and if we want to help the millennials get on the property ladder before they're friggin' 50, then we have to do stuff like this. And this is essential. Now, Is it just rehash Help to Buy? Possibly, yeah. Help to Buy has been a great system, and actually I love any of these concepts that gets people onto the ladder. It changes people's lives. I've seen it happen. I've done it with my staff. I work with all my staff to get them into their own property. You know, it's one of those things. But one of the things I always say is you have to save 5%, because I have a big belief that if you can save 5%, yeah, then that's the discipline required to maintain a mortgage. Yeah, so 5% over 6 months minimum, and that doesn't mean your parents give you 5%. You save it. Yeah, so if you're a millennial or you're not on the property ladder, get that 5% in track. Okay, good. All right, so let's go switch it up to London, because I think London. Look, I mean, I love London. London. Overseas lack of overseas buyers hits prime property market. Now, remember, this is overseas buyers' prime property market. Sales and rentals are down, the capital's most exclusive postcodes. And you know what? They are, and I'm not surprised. Yeah, because to be fair, most people don't really know what's happening. There's not the demand that's happening there. Plus, with the lockdown and all that sort of stuff, it's a bit of a disrupted market. But as we'll see, very soon in my final rant, London actually is a bloody good market, and a little bit of coronavirus, a little bit of that's not going to affect it. It is always going to be a fantastic environment. Hey guys, I just realised I hadn't mentioned, if you've got questions or comments, actually the comments haven't been coming through, I noticed. So maybe if you've got questions, you should be able to type them in, and they should be able to come through. I'm using new software, so I'll just have to check that, because for some reason there's no comments or anything right now. But anyway, if you've got a comment, type it into the thing. We're actually using new software, so I'm going out on Facebook and YouTube right now, and also our own website, so you can sort of watch us anywhere. But yeah, great. So so London. Why I think London is great, and why I think the overseas buyers are there. We're seeing a lot more London buyers, interested buyers. But the interesting thing between now and the last recession, okay, is that the last recession, international buyers were only buying London. They could only buy London, all right? But what's happened now is now they can buy Manchester and Birmingham. Probably not much else, okay, because of the capital values, all right? They can probably buy commuter towns, but it's not really what they want, yeah? So they're looking for the city centre stuff. And the reality is with that, what that means is that with the city centres, that's London, that's maybe commuter-ish a little bit, but not really Manchester and Birmingham. So they're now, that demand is spread out. But one of the other problems they've got is mortgages, yeah? The mortgages have got harder. Yeah, make no mistake. And there's a bit of fear about the tax changes, but for the most part, they see the pound low, they see all these sort of changes, which, is quite interesting. So let's have a look deeper, overseas property investors rank, because I've sort of gone on about it. But look, UK residential property, window for opportunity. Look, weak pound, we've got a robust economy. And I say robust, a lot of people will argue with me and say, no, Brad, it's not a robust economy. It is a robust economy. I'm sorry. I don't give a crap what you say. If you look at what it's been through and where it's at, it's doing bloody well, and it's still a flight to safety. So if the S hits the fan, then it'll be a flight to safety without a doubt. It's a 1,000-year-old market that's been around forever. There are future taxes, but that's an opportunity for now. Okay. And that's one of the good things that we're seeing. So we are seeing, an increase in interest. And chatting to a lot of guys over, here in Singapore, some of the guys I know in Hong Kong, they're still seeing movement. China is still seeing movement. So all those places are still seeing movement and things happening, which is great news. Okay, good. Okay, guys. So let's have a look at Brett's rant today. So I wanted to change it up, and I want to really get you, and this is the thing. I'm going to show you London. Okay, and I'm going to show you bits about London, but this is not about London, okay? It is about London, but it is about everywhere, and it's about fundamentals. If you remember last week, I talked about shops, schools, transport links, major employers, major investment, yeah? They're the things that you want to search for, because that's in the areas that are going to rebound the quickest. And in the absence of knowing who to believe and who to trust, because most experts are wrong most of the time. Some are telling you it's going to go up, some are telling you it's going to go down, some are telling you it's going to be the worst recession since the Great Depression, the worst in 300 years, all this sort of stuff, that there's going to be a massive, inflation come kicking the tail, all this sort of, statements. Who do you believe? Well, the best thing to do is don't believe anyone. Yeah, don't believe anyone, but go and where the fundamentals are. So let's have a look. I want to show you some stats. I was with PB Barabas, my wealth managers, and and so I'm at a webinar they did on basically, it was primarily for office and non-residential stuff, okay? So it wasn't so much residential property in London, it was all the major cities in Europe. So, but if you have a look there, and the interesting thing I thought here, investing in prime city centre locations, capital value, historical low volatility of capital. You know, London is there, central London, 10% volatility, but it's the highest price, but that doesn't matter. It's one of the best markets. And interestingly, on that slide, if we zoom in, you'll see Central London is one of the most resilient markets, and that is so true, okay? So I think this is what you've got to realize. This is the office space we're talking about here in particular, okay? Right now on this slide, yeah? Not residential, the office space. Now, a lot of people are saying, well, office space, you know, nothing's going to happen here. It's everyone's moving out of the suburbs, people are working from home, it's going to be tragic. And to a degree it will be. But, and I'll talk next week, my topic is on the future of buildings, okay? Because a lot of the buildings now, the old ones that are really inefficient and are not easy, they've got small lifts, they've got bad working spaces, bad ventilation, they are going to struggle, okay? But the future buildings, the buildings that are being built now, like Google headquarters, have a look at that and the technology they're putting. It's a smart building. It's efficient. It uses, certain glass that takes out the light and does all these sort of things. And, all these buildings, that's the future of where things are. And those buildings will be fine. So really, we're moving towards, and at quite a rapid rate of knots, to where we have a future that actually looks quite bright from a building perspective, from a built environment, as we say, perspective. So London is resilient, okay? But if you buy with the best fundamentals, then you're guaranteed you're going to get growth. Now, when will that growth happen? It may not happen now. It may drop, but it'll come back the quickest. So if you're looking to buy and you don't know who to believe or, which experts, are we going to drop massively, 300-year recession, or are we going to go up, we're going to have a year, slowdown and then go up after that. If you don't believe, then buy with the best fundamentals and buy with a strategy that meets the market and mitigates that risk, okay? Now, interestingly, London too, because a lot of these things with London people are talking about, they're saying, well, no, London's had its day, Canary Wharf, look at it now, there's no one there, all this sort of stuff, okay? So yeah, but basically, look, this is London now, and I want to show you this. So if you think back, the financial district used to be the City of London, which is where that CBD is in the middle of the page. And then basically over at Canary Wharf. So they were the two, if you like, centres. Now, Canary Wharf is still a financial centre. It's still a massive centre. And so is the city. But now what we also have is these three hubs, okay? We have one around King's Cross, yeah? And these are massive tech hubs. Because guess what? Right now, London is the centre of the tech revolution in Europe. And that's a big call to make, but you know what? It is a true call, okay? More so than anywhere else. We've got King's Cross, we've got Farringdon, which is in the middle there. And then we've got pretty much what they call the Silicon Roundabout, which is the Old Street Roundabout, Shoreditch, that area, yeah? Amazing things happening there. And that's a sort of a zoom in, if you like, and some of the other stuff. This was, again, PB and Paribas, the webinar that I was on. It's the largest tech hub in Europe. So anyone that's sitting there going, oh, but financial, or, HSBC has moved their head office up to Birmingham, it's tragic for this. It's crap, London has just gone in its stride and gone, bugger off up there, we'll find somebody else, we'll find a new tech. And guess what? Financial services now is getting taken over by AI, it's getting taken over by tech, and they are being ruled by the big 7 companies. I love it, 7. 7 companies, Google, Facebook, what is it? God, brain's gone now. Google, Facebook, Tencent, Alibaba, Amazon. I've forgotten 2 of them, isn't that terrible? Anyway, the big guys, okay? Because of the presence of data. And now big data is where it's at. And guess what? London is the center of that. So anyone that's saying London isn't it, on your bike, because you don't understand what is going on. Okay, so guys, the future's bright for London, and this is the great thing. Go to Manchester, have a look. And guess what? It is an amazing tech hub as well. Yeah. Go to Birmingham, look what they're doing there. Amazing things. These are becoming modern cities. Yeah. Modern cities of the future. They have visions. They have, look, for what all London is, it's very hard to change London because it has that character and it's, hundreds of year old character and old buildings and things like that. Walk into some of those old buildings and what do you find? You find gigabit, internet all the way through, wireless, even though they've got thick, cement walls and things like that, they are modern day buildings of the future and becoming more so as they get renovated, so that, above all will mean that market increases. And guess what? Manchester, Birmingham, to a lesser degree, Liverpool. Liverpool's a bit of a different story. Liverpool's more like, I'm not going to say it's a cheap, it's still, I'm not going to say it's cheap. Cheap's not the right word. It's down. So yeah, so there's huge opportunity there, and there still is huge opportunity, and there will be huge opportunity. So anyone that says, "Oh no, that's no good," we can't do that. So I just saw. Okay, so we've just got a comment. Is this in Stoke for winter? So this is Garbars. What's the predictions for housing market in Stoke for winter 2020 and 21? So my predictions and look, my challenge with Stoke, funny enough, my grandfather's actually from Stoke. So, but I don't really keep up to date. So the intricacies of the market, but we have got quite a few properties there. But look, what do I think for, and this is not just for Stoke, but this is for most of the places that are outside the major cities. Yeah. What you've got to look at, okay, is what is happening in those areas. I mentioned fundamentals, shops, schools, transport, major employers, major investment. Major investment. What's happening in Stoke that actually is major investment that's going to change the fundamentals and upgrade the fundamentals and make it actually, interesting for people to live there? Because this is one of the challenges. If there's nothing happening, and I know Stoke had a big, all the roads got redone and the canal there got redone, and we actually invested in there back, I think that was probably 10 years ago now, maybe even more actually. But the reality is what's happening now, I think things are all going to slow down. So outside the city centres, things are going to slow down. I think actually things will slow down even in London's and all that sort of stuff, because people are, people I think are more interested in just bedding down things. There's not the demand for pushing prices up. So I think prices will probably come off a little bit, but not stupidly. Yeah, I mean, we're already talking to developers, and developers are like, you know what, we've had a good time. We don't need to discount. We don't need to drop our prices. If you look at the Rightmove statistics and the Zoopla statistics and all that sort of stuff, you're seeing they're not dropping their prices because they don't need to. Yeah, so that will slowly correct itself, and there'll be people who need to sell, and sure enough, yeah, that will happen. But the reality is, what do I think? Do I think prices are going to drop massively? Not at this stage. Yeah. I think if you want to get something, you'll be able to negotiate it, and you will be able to find somebody who is willing to do a deal. Okay, there will be people like that because there'll be people losing their jobs. I mean, if you're in an industry, and actually this is another topic I should cover really, when we talk about the tech, if you're in an industry that's either, let's talk about it, is either being massive change disrupted, yeah, you've got to look and say, well, hold on a sec. If it's being massive change and disrupted, am I going to have my job in the future? And if you're not, then you need to consider, well, what happens if I'm unemployed? What happens if I lose my job? Maybe I need to start retraining. Maybe I need to pivot my industry. So, this industry is not doing or has no future. I'll jump to this industry. Or possibly, if you're sitting there and you go either A, no, we're not getting disrupted. We're fine. Everything's the same as it was. And if you start telling yourself that, then I suggest you go and quickly work out, because your industry is getting disrupted. Your industry is getting, changed, and there is IT and there is technology and there's AI and taking over all that sort of stuff. And I think if you aren't aware of that, if you're not, looking at that, then you may get a big surprise where someone goes, hey, we're making redundancies, see you later, get another job, and you haven't transferred over. So I think it's really important that you now start looking. Yeah, because this is not happening in 20 years' time. This is happening in the next 5 years, the next 10 years. It's already happening. Look at, people aren't talking about London's tech hub, even though for the last 10 years, that's what's been happening, almost under the covers of darkness. No, it's been happening and people have been aware of it. But most people are like, oh, but the financial, the banks are leaving and Brexit. It's like crap, you know? There is so much good stuff happening. And there's, you know, and in certain areas, there is great stuff happening that means the fundamentals, you know, will be maintained. And so therefore, you know, it's worth investing in. But what I'd say is if there's nothing happening, don't invest there. Because guess what? As the kids grow up, guess where they go? The cities. Now, I know a lot of people are saying coronavirus is going to mean that no, they're going to want to go out. No, that's a short-term thing. And yes, there will be a percentage, but it's not going to be a huge percentage. So hopefully that answers your question, Garbaz. Yeah, thanks. So any other questions, guys? That's it for me today, pretty much. So yeah, so if anything, you know, anything else, you can always email in webinars@gladfish.com. And I'll answer this, and I answer the questions on here, or I'll answer, you know, cover the topics, whatever you want me to cover, and that sort of thing. But guys, remember, you know, it helps me out if you like the stream, if you obviously watch my videos, subscribe, and all that sort of stuff. You can also go onto the website if you want any help building your portfolio and working out strategy, you know, and really getting a sense for, or some certainty about what's going on, you know, to chat to the team. Just go to gladfish.com. And then, yeah, chat to one of the team, and they can take you through, you know, where your current situation is, what you're looking to achieve, and really make, you know, give you that certainty right now. Which you might say, well, how can you get certainty now? Well, you can get certainty, but part of the certainty is, right, if this happens, we do this. If this happens, we do this. Yeah, and we don't, you know, we keep our powder dry, as they say. You know, we don't expend all our powder right now. You know, so, you know, that's what we can do there. Also, the other side of it, if you've got properties that you want to manage, you know, compliance and all that sort of stuff, then we've got easytrack.co.uk, which can also help you. That's my other business that does all the property management, you know, finding new lettings, all that sort of stuff. And actually, we're just now, as of Monday, well, we're starting the office in London with, so we've got the letting guys in London, so we're going to be sending them out, going and finding tenants for us and doing all that sort of stuff, which is great news. So I'm really looking forward to the next sort of 6 months as that sort of really evolves. But guys, thank you for listening. I don't think there's any other questions. I'm not sure if it's working. I know the YouTube one is working. I haven't seen the Facebook one's feeds. I tested it today, but anyway, but it doesn't matter. So yeah, guys, we'll see you next week. Any questions, webinars@gladfish.com. But I want to thank you very much, and we'll speak to you later. See you later. Bye.